Hello and welcome to American Mogul. We are going to cover stock market prediction for 2021. Yeah, I have to apologize. I took my medication. I'm going to start a little bit. It happened. What can you do? Um, there is a lot happening in the world. Yeah. Right now, do you know how many people work in the world? Yeah. Approximately 3.5 billion people work in the world. Yeah. And why I say this is participation rate. That means the amount of people, of the available people that can work is 60%. Yeah. Which gives us, if 60% of the people who can work are working, that means 40% of the world is unemployed. Yeah? That's 1.4 billion unemployed, or if you like to say underemployed, in the world. So, what does that tell you? 2.1 billion people have to maintain 1.4 billion. Yeah? Now, those are working people. There's a lot of, children, elderly, and people like that that are part. There's, almost 8 billion people in the world. And half are working, roughly. Yeah? So 7.5 billion, 8 billion people in the world, 3.5 billion available to work, and 1.4 billion unemployed. It is huge, huge problem. Yeah, it's inconceivable that we can maintain something like that. Governments, central banks around the world are just printing money as fast as possible to try to keep everyone from losing it, from losing everything. Yeah, there's a very small minority of people who are profiting from this, but most of the world is suffering. Yeah. So when you look at global markets, the entire global market in March of 2020 was worth $60 trillion. Yeah. And what the increase of unemployment globally to 1.4 billion unemployed, or if you like to say underemployed people, the global market value went from 60 trillion to over $100 trillion. How is that even possible? How is that even possible? You have the greatest number of people unemployed, right, in the history of the world. And you have the greatest asset increase in the stock market in the history of the world at the same time. It just defies logic. Yeah? one of the things that I use indicator. I've been investing in stock market since in the 70s. Yeah, 1978. I think it was 76, 78. Long time, long time ago. Well, the market goes up, market goes down. But what I use are one my gauges. Yeah, margin debt. It used to be back then, in the 80s, we'll say, if margin debt was 100 billion or less, it was a good time to invest because people didn't want to borrow money to invest in stocks. And at that time, the stock market wasn't really what people wanted. The stock market goes through cycles, yeah, where it is the hottest thing, and then nobody want to touch it. Usually, when it's in euphoria, everybody wants in. Everybody mortgages everything, and then when it crashes, nobody wants to ever see it again. Yeah, they get wiped out. So, what I used to do, if margin debt was 100 billion or lower, I used to, a little bit at a time, invest in the market. And then when margin debt went up to 300 billion, that was euphoric, and I would get out. I would slowly get out. You got cash in. You can't. Uh, I have held stocks sometimes for a couple hours, couple decades. Yeah, I mean it just depends on investment, the time of investment, what I believe. This is all my belief. Do your own research. Yeah, you have your own brain. Figure it out. But a good guideline, and then you adjust for inflation. Yeah. In the 90s, it became 200 billion to 400 billion. That was if it went under 200 billion, it would be like a green light. Start investing. If it went over 400 billion, it was a red light. Start lightening up. Slow down. Yeah, things are getting to. So now if you adjust, now the benchmark is in the 2020s. If margin debt is 300 billion or less, it's time to get in a little bit, look around, because that means people are not interested. And if it's over 600 billion, it's time to inch out a little bit. Well, right now, margin debt in the U.S. marketplace is almost $1 trillion. How much over 600 billion? It's almost double. And if you take a look in the world, margin debt is like $2-3 trillion. It's huge. Because you gotta think, when they're looking at margin debt in a stock market, they're money from all over the world. They're taking margin not from investment firms in North America or United States, from their local, right? Their local country financial system, their investment firms there, they take margins there. So that is on top of what you think margin debt. And now let me explain to you what I think is going to happen, and then I'll explain how it happens. So I think the market going to go up to about 3,900. Yeah, by the middle to beginning of February, something that, and then it's going to start turning down. I think it'll go back down to about, and I'm using S&P 500. Yeah. But I can do it in percentages because all markets are pretty much the same. Just some are going to suffer more than others. Like, I think Dow is going to suffer least, then S&P, then NASDAQ, and then the Russell, right? who's going to be worse? Russell going to be worse. Yeah. Then Nasdaq, and then S&P, and then Dow. Right. So market can go up another 5 or 10% maximum, and then going to drop quickly, I think. And that's a lot of things can affect that. The drop can be 2-3%, 5%. I'll give you an example of one catalyst that could cause that. If the Democrats win the 2 seats in Georgia, we could see a steeper decline. And then the buy the dip crowd, yeah, they will jump in and bring it back. But what it will do is a double top. Yeah, it will get almost, or maybe a little bit past the previous top that's set in middle of January to like mid or end of February. And then once that double tops, it's gonna go down. And it's gonna go down for at least 9 months, yeah, 10 months. I think it's going to drop 25 to 30% steadily, some sharp drops, then a little bit, plateau, and then drop again. And why going to happen? When everything going up, people get euphoria. And I remember I've been through bull and bear markets more you can imagine. It always ends the same way. Start the same way. Start different a little bit, but end the same way. Yeah, history repeats itself. I have many friends. Their life savings, right, and they will come to me because I've always been pretty good with my money, and say, okay, I want to invest in the stock market. What should I do? I go, well, depends how you want to invest. Yeah, you want. Because back in the day, before the crash of 2000, you could do E-Trade, you could trade online. So I said, you do what you want, but this is one brokerage firm you can go to, decide on your own. Anyway, a lot of them took 50 grand of their savings and invested in the stock market. Yeah, in 2006, 2007, in 96, 97, 98, market kept going up, 99, and they took that 50,000 and turned it into 500,000. I'm not talking about one or two of my friends, almost all my friends. Yeah. And there was so much euphoria, so much it was like they were multi-billionaires all of a sudden, yeah. And we're talking about $500,000. Well, I guess in 99, 2000, that was a lot more money than today, purchasing power. So they would come to me and say, look, my broker told me about margin. I could buy more of my stock. I said, don't do it. Don't do it. Play with the money you have. Like I told them before, play with the money you plan to lose. And if you make, great. But if you lose, you handle it. You could margin up to 50% of your account. So a lot of my friends who made $500,000, yeah, margin half of it, 250,000. Yeah, this is late 99. And they bought what they had. They figured it's gone up 10, 20 times what I put into it. Imagine another year goes up another 10 times. I'd be multi-millionaire. Well, when the floodgates open, they lost not just their money, they lost their margin. A lot of businesses just went out. Yeah, they disappeared. Okay, this is end of part 1. I will go to part 2. Okay, hang on.